Hello, everyone. Thanks for joining us for our live webinar. We're going to be exploring the risks, challenges, and mitigation strategies associated with identity fraud. As you can see on the screen, we have some industry experts with us today. But before we get started, just a couple of housekeeping items for everyone. You should be able to see a Q&A button. Please go ahead and use that at any time during the webinar to ask your questions. We'll get to those. Following the end of the last slide, as many as we can cover, we will. We'll have our experts answer those as much as we can, as many as we can. All right, we're on time, so let's get going. I'm going to hand it over to our experts today. First up will be Ravi from Effective.
Hey, thanks, Dan. Hi all, I'm Ravi, co-founder and CEO at Effective. We are a real-time risk management platform specifically designed for fintech and financial institutions like banks and credit unions. We have our AI-driven solutions across the entire user flow, starting from onboarding to payments to credit underwriting checks, as well as things like login and so on. We've been working in this domain for a very long time. I won't reveal how many years because that'll reveal my age, but we've been doing this for a while. Been working with several large organizations in the past. I'll hand it over to Michael from BIG.
Thank you, Ravi. To introduce myself, Michael Coomer. I am the manager of fraud management with BHG Financial, specifically working in the BHG Money side of the business. Company itself has been operating for a little over 20 years, and in that time has provided funding of up to $14 billion in regards to consumer, commercial, and credit card products. For my space, I primarily oversee a team of investigators that are utilizing all of the really advanced tooling that we've been able to partner with, particularly with Ravi and Vivek, and which we'll be talking of how we utilize that in this space to try to mitigate, reduce, identify, and prevent fraud in our business.
Hey everyone. Yeah, good morning or good afternoon for those of you on the East Coast. Vivek Ahuja from Centrelink. Centrelink is a solution provider in the primarily the application fraud space. We work closely with Effective as well as BHG. I lead our business development efforts, and I have a background in fraud. So before crossing over to the dark side of providing risk solutions, I was leading different risk capabilities, primarily at the online lender Affirm, where I led merchant risk management there. And Centrelink is a company that's been around for about 6 years, now working with 7 of the largest 15 banks, 6 of the top 10 credit unions, and a total of about 300 financial institutions. Our solutions focus primarily on synthetic identity fraud, ID theft, first-party fraud, and other sorts of identity-related risks.
Awesome. Yeah, thanks, Michael and Vivek. Couldn't have asked for a better set of panelists to talk on this super interesting topic. But yeah, as all of you know, we are going to focus on identity fraud. Obviously, there are multiple kinds of fraud that a financial institution faces, but identity is where all of it begins, right? And if you have a strong system that's able to identify and stop fraud right at the beginning, then you're all kosher after that. So we're going to spend a lot of time talking about various kinds of identity fraud that could happen to your financial institution, and then obviously how we can mitigate and so on. We'll talk about both of these topics, both defining what it is and how we as the 3 partners look at these things and how we mitigate them. But we'll also try to summarize at the end so that you get a broader idea of how all of these can be tackled. So we'll kick things off with first-party fraud. Oh, actually, before that, let me give you a lay of the land, right? These numbers, what you see, are true, though very mind-boggling, right? So just over over the last 2 years, there's been over 200% increase in fraud losses, right? And more than close to half of banks and financial institutions have faced some form of fraud in the last 2 years. Of that fraud, which is around $90 billion in 2021, $60 billion has been caused due to identity fraud. And that's why we are so interested in speaking about this topic today. And very specifically, identity fraud has been growing close to 80% year over year, right? So this is a very rapidly growing problem, and it's just going to increase more and more as the digitization increases across the board. So very relevant topic in our mind, and we're going to try and cover a lot of these topics today. The next slide, please. So we'll start off with the different kinds of fraud. As you could see in the agenda, there are three broad, I would say, types of fraud in the identity space that are very relevant. We'll start off with what we call as first-party fraud. First-party fraud is basically someone trying to misrepresent their identity or creating a relationship with a financial institution with an intention to eventually commit fraud, right? So it's interesting. So I'll turn over to Michael and see how he and his team define this problem and what they're seeing on the BHG side in this area.
Thank you, Ravi. So just again, one of the things that we really want to focus on throughout this event is the idea that the different typologies represent and present themselves in unique ways, but they also overlap quite a bit. And depending on the industry, those classifications and those definitions might slightly change, but the behaviors and the patterns are ultimately consistent. For BHG and for our team, when we classify first-party fraud, we're talking about a true individual. We're talking about a person who is presenting themselves as who they are. If I'm applying for a loan, I provide my date of birth, my address, all of my personal information that is consistent or is accurate. But I am lying about material information, but my financial records, in order to gain access to funding, in order to gain access to capital that otherwise I wouldn't be able to qualify for. A lot of times where we see that is in regards to tax documentation, financial records, pay stubs, bank statements, etc. So it's really going in and making material changes, edits to those documents that lenders, that financial institutions rely on to evaluate the strength of a profile and whether or not we feel comfortable lending to them. One of the biggest issues that we're seeing in the most recent years is the ease of access to tools and systems that allow regular individuals to come off the street who have no prior history in criminal activity of making changes to those documents. And in particular with the urgency, the uncertainty that people are feeling with the economy, it's definitely seeing a shift since COVID of pushing people into that space where they don't necessarily realize what they are doing and what the consequences of that action are. So it's really a hard thing to necessarily identify, but by partnering with tools like Effective and Centrelink, we actually noticed that the systems and modeling that we can apply for other types of fraud vectors and attacks typology actually overlap with first party as well, even though the profile itself seems to be clean and seems to be legitimate. I want to give everyone else a chance to jump in here as well. Don't want to take up too much of everyone's time there.
Cool. Yeah, thanks, Michael. Super interesting. I think especially coming from a creditor or a lender point of view, this is a very, very important space, I would assume. I'll just would like to ask Vivek on his thoughts. Obviously, Centrelink, I'm sure you're looking at this area quite a bit as well.
Totally. Yeah, thanks. Yeah, and Michael, thanks so much for, I think, calling out earlier in your answer, sort of definitions are important here. For us, our definition generally aligns with yours, which is a first-party fraud is fraud where you have true identities, but there's sort of an intent to intent to defraud the institution. The identity before you is real, being controlled by the person on the application. This is probably the hottest topic that we're hearing from major banks and credit unions this year. Broadly speaking, the main types that we've been hearing about the most, so I'll bucket it into sort of lending related first party frauds, and then DDA account or sort of DDA, deposit, debit, checking account sort of first party fraud. So on the lending side, the main first party frauds we're hearing about are false claims during the false identity theft claims, which we refer to as credit washing. So there is sort of forms of, I call it like sort of serial credit washing, people that are abusing this system that we have for reporting ID theft claims. Sort of growth of abuse of that system to try to remove trade lines from one's credit report, therefore, misrepresenting your creditworthiness to other lenders because you've been able to take out trade lines and sort of wash them away. The other has been authorized user trade line abuse. If you're not familiar with this, this is a type of behavior where consumers can add themselves as authorized users onto credit cards in order to basically make themselves look more creditworthy than they actually are. So that's mostly what we're hearing about on the lending side. And then on DDA accounts, it's also false claims, but for ACH transactions. So the idea of a consumer initiating some sort of ACH transaction and then making a false claim that they didn't actually initiate it and using that to sort of abscond with funds that way. And the other would be, which is is check fraud, just sort of classic check fraud. I personally would consider this a type of first party fraud if this is a situation of the consumer using a valid identity, valid elements that they control, but presenting fake checks.
Yeah, that's very, very valid points. I think we are at Effective as well. I think we're seeing this a lot, and it's a very hot topic for all of our partners and customers as well. I think very interesting topic again on the definition of this is, especially I think Michael and I think Vivek, you also brought it up on how do you like differentiate between, is it like a credit risk issue because it's the same person eventually not repaying the loan from a broader sense of view, right? But it's truly a fraudulent because they're already intending right at the beginning to not repay the loan. So how do you look at it, Michael, on your team, and how do you try to differentiate between like the underwriting team or the fraud team and who handles it?
Yeah, it's interesting, and Vivek, I will want to take this first, if you mind. Is the idea is, yes, I think it overlaps with some aspects that used to be classified as credit risk, right? And those individuals will definitely pose some behaviors and patterns that are usually identified in the process of recognizing bust out accounts, right? Bust out fraud primarily has been classified as a credit risk, right? We see increased activity in terms of inquiries, in terms of trade line, appearance of risky vectors, and or overloading their available credit caps on that. However, with first party fraud, what we're really talking about is they are going in deliberately changing aspects and modifying that in such a way that it falls into a true fraudulent activity. But Vivek also mentioned what then overlaps with some other typologies that are a little bit more complex that we're going to be talking about a little bit later as well, which is those first party synthetic, which comes out of traditional credit washing patterns, right? Because they go from disputing trade lines to end up using CPNs and actually creating entirely fabricated or based off of true information, fabricated separate credit accounts that hide all the negative activity that we would have previously seen as a credit risk. So it's really unique that these are distinct and yet they blend in with the other typologies. Vivek, I wanted to get your chance to weigh in on that as well.
Yeah, so just, I totally get the question. And it is something that, yeah, I mean, for a financial institution, obviously being regulated and being concerned about FCRA, not wanting to decline consumers and sort of run astray of any of those sorts of concerns when you're talking about first-party fraud and that link to credit risk. So a couple of thoughts there. One, being really airtight on how you're defining first-party fraud as part of a credit or fraud policy, and also having a lot of the data to back it up, I think is also really important. So it's not Michael alluded to looking at velocity behaviors or inquiry behavior and incorporating that into some sort of first party fraud policy. Like actually having strong data to back this up is really important. From us, from a solution provider perspective, often I'll tell people, hey, our models aren't here to predict when someone's lying. There's no way that like on any given sort of isolated case of a claim, an identity theft claim or an ACH fraud claim, sort of being able to tell whether someone's lying, that's not what we're here to do. We're here to detect a lot of the serial behavior. So that's also where I draw a distinction, is that there are certain, actually, to Michael's point earlier, a lot of these fraud behaviors overlap. A lot of the types of individuals that are committing synthetic fraud are also committing other types of first-party fraud or false claim behavior. And so actually being able to identify when there's serial or repeated behavior is also something that can help distinguish between something that's a credit risk versus an intent to defraud an institution through first-party fraud. And so that's how we've approached it, is being able to detect sort of those serial credit washers or serial abusers and capture them in a high precision way. It would be unrealistic to think that you're going to be able to capture 100% recall with super high precision, but you can capture a good amount of that first party fraud behavior with high precision if you just focus on those serial disputers.
Yeah, makes a lot of sense. I think it's all on the documentation on how you define it and be very clear as an organization. I think we saw some credit unions actually being super clear, like having a very simple criteria that, hey, if we identify that they're doing something wrong within the very first repayment of the loan, then we'll consider it as a fraud issue. If it goes beyond that, it's a credit issue. But obviously it's not that black and white, and there are a lot of nuances there. Cool, awesome. I think, great discussion. We'll obviously speak a little bit about how you can mitigate a lot of these types of behaviors at the end when we summarize. But let's move on to another very interesting topic of third-party fraud, which is probably the most, I think it's the wrong word to use, but the most popular kind of fraud that organizations face, right? And this has been happening forever. Obviously covers, again, definitions here, right? So generally how at Effective we try to define third-party fraud is someone stealing someone's credentials or identity to act as if they're someone else, right? And using someone else's SSN and name and address, and then applying for a loan, again, obviously to not intending to pay or basically defrauding the organization. Michael, over to you on this. I'm guessing this is a big problem that you see at BHG as well. So your thoughts on it?
Third-party fraud is one of those things. It's the traditional typology, right? It's what most people think of if you're talking to someone outside of the space. When I describe, hey, I'm a fraud manager, they say, oh, you catch people who've stolen someone else's identity. And yes, it's the baseline, right? It's the foundation of a lot of what we do in this space. And it is essentially where the starting point is for a lot of fraudsters, right? And particularly with the proliferation of data breaches that are occurring across all industries, with the essentially unreliable data, it gets easier for third-party attempts, advancements in AI, to actually fight against ID verification software that the company, that industries have relied on heavily to ensure that they're talking to the real person. That advancement makes it that much harder to identify third-party situations. What's really great, tool like Centrelink ultimately is building their product into to identify the use of certain data points and to give us insight into how often we're seeing it associated with a profile, rather than traditional systems that simply looked at, does column A match column B, giving us further insight from an investigator standpoint to validate whether it should be seeing that at the rate that we're seeing and whether it is authentic or not in terms of those associations.
Yeah, I mean, I think on that topic, actually, Michael and Vivek, you can also jump in. Is there's this big trend of romance scams, elder fraud that's happening, right? It's still the same person actually initiating the transactions or drawing out a credit line and passing out the money there, but it's still actually being triggered by someone else, right? So do you see romance scams and elder scams as third party because the behavior is very atypical to the actual user, or is it the same? So how do you look at it, and what do you guys think of how we can identify that kind of fraud?
Vivek, why don't you cover it from a modeling and detection standpoint?
Yeah, I think based on the sentence we have on this slide, I think like you could argue that it is a type of third-party fraud. I think from a modeling perspective and data science perspective, we would classify that as a scam and different than fraud, right. Not different than an application level fraud. And then from a sort of data science or modeling perspective, if you were trying to capture when this behavior, whether someone is maybe being coerced through a pig butchering or romance type of scam, the sorts of data that you would want to focus on would be device-based or browser-based, or information about sort of the interaction digitally, rather than the application level data from the consumer. There's another element here, which is for banks and credit unions in particular that operate branch locations, the sort of training. We'll get into mitigation strategies later, but broadly speaking, we probably classify this in a different bucket from a data science perspective.
Makes sense. From an investigative standpoint, we often look to it as it is in these situations. If we have elder abuse, if we have romance scams, you ultimately are dealing with a potential victim. So yes, it is third party, even though we may not be directly communicating with that outside individual, though they are either coercing or controlling the behaviors of who eventually serves as their target or their victim in this scenario. So it overlaps, and you necessarily have to approach it in the same way, right? You might see changes in patterns or in the communication that they're providing. And that goes also back to first party with the idea that it overlaps, right? The Venn diagrams and the actual lines are very blurred in regards to differentiating these typologies, because maybe they're using new emails that don't have a lot of history with them. The bad actor has advised the person or the victim to use a VoIP so they can't track them down after the fact. Or we can even look at behavior or activity on bank accounts to see if there's rampant or rapid transfers of money to outside sources, or an increase in activity that is not consistent with what we've previously seen from the user, from the applicant, in those types of exploitation or exploitive scenarios, right? But in true third party, it is all of the lack of information that has regularly been associated with that individual, right? You might have new addresses that are only associated via credit trade lines versus inquiries, or less maybe reliable sources, right? Phone records, newly acquired trade lines, newly acquired information that doesn't have a whole lot of validity behind it. So that's what we still rely on from an investigative team across multiple systems that are supported by the initial process of identifying and essentially tagging it for review, which we on our side use both effective and Centrelink so heavily to say, hey, this is something that is concerning. now go into deeper details to evaluate whether it really matches up against those fraud typologies.
I think one like a very close related issue, like which Vivek actually just briefly referred to, is an account takeover scenario as well, right? So where someone actually loses their online credentials and login, which we see a lot at Effective as well, and we rely quite heavily on biometric data at the device level, how what time of day is the login happening, what browser is being used, so on and so forth, right? Is it something of an issue on the lending side, Michael? Do you see an account takeover ever coming into your purview, or
Yeah,
an issue
it's
that
an
you see?
interesting scenario, right? Because as we mentioned before, primarily what we're dealing with is new account fraud, right? Opening of accounts,
Right.
and trying to identify before the funds go out to the prospective borrower, the individual that we assume we're dealing with. In some instances, you might see through the loan life cycle that those communication channels are changing, right? They come in with one phone number and then it suddenly changes, or an email is, hey, we actually would prefer you contact us at this email after the initial credit approval stages. So it's tracking that behavior. And again, I don't want to get into too much of the mitigation strategies that we'll talk about later, but that's an important aspect and component to be aware of, is there's certain behaviors will display and present themselves at different times throughout the process. And ultimately, it's a lot of reliance on outside departments, sales departments, of identifying any changes of that communication. Their behaviors, as well as just simple voices, may change. And it's because someone else has stepped in, where that somewhat is an account takeover concern. We have had instances of that occur, both in an exploitative and in a true, hey, they aware that someone is in the process of a loan, so they take it over partway through. It's a really unique scenario, and it's very fast paced in that regard.
Interesting. Cool. Yeah. I mean, obviously, huge topic. Vivek, please.
Yeah, just to riff
Right.
on that a little bit from a lending perspective, and actually to Michael's point earlier, sort of the ATO during, or like sort of early in an account opening and customer relationship will look very different than often look very different than the ATO like after a relationship has been established with that consumer, and they may have been sort of on a financial institution's platform, or in their customer base for a while. On the lending side, I would say probably see a little bit more of the latter, where I guess the way that I view it, or a team would view it, is like anytime there's a contact change or contact change request for a phone or an email, is where you need to be where you can use tools to sort of evaluate the riskiness of a new phone or a new email or the device, so the device identity related things at the time of that contact change. A very interesting trend that we've seen towards the account opening side is, Michael, I'm not sure if you're seeing this on the lending side, but especially, I would say we see this a little bit more in DDA, debit, savings checking accounts, is a very rapid contact change request basically during the account opening process. And the institutions that are the most susceptible to this are the ones that aren't thinking about the phone and email like active verification during the account opening. Those are the ones that are getting hammered by this MO, which is the it's sort of a blend of identity theft and ATO, and typically done right at the start of a customer relationship. So I would just call that out as what we're seeing.
No, that's a great example, because we actually do see that, and a lot of times you'll see both contact information changes immediately after approval or an account is validated. You'll also see bank account changes, right? So the funding account will be suddenly different, and it will, because verification happens on the front end to ensure that, hey, this is an account we can send money to, but maybe it doesn't have the same level of rigor to ensure that the account that's paying us back, that debits are coming out of, is the same one, right? They transfer that over, particularly in any sort of AML concern as well. You'll see that occur if there's credit muling, et cetera. Those are definitely those situations where you might see that change also.
Yeah. No, that's that's something that we are seeing as well, right? Not just when the loan is being like created, but also repayment of the loan. There's account takeovers of another account that's linked to the loan account to continue the repayments. Yeah, very interesting. Cool. Now jumping into a super interesting topic, which is something I think has come up in the more recent times. We've seen this happen a lot with the PPP loans, for example, which is a big issue that most of us know about. And with the digitization happening across the globe, especially with banks and credit unions and lending companies in the US as well, this is a very, very fast and growing problem, right? And what synthetic ID fraud we define as is someone fabricating an identity, either mixing and matching information from real users or completely synthesizing a brand new identity, right? Like creating a new SSN ID and so on. Obviously, Centilink are industry experts here, so I'll let Vivek jump in and throw more color on this issue.
Absolutely. Yeah, so for us, for those of you not familiar with Centilink, our first sort of commercially successful product was in synthetic identity fraud. And I think a big reason why our products have been sort of successful and have grown a very strong brand at being able to stop this type of fraud actually has to do with the definitions themselves. So the way that we approach it from a modeling perspective is, well, we have a very sort of wide taxonomy of different forms of identity manipulation and fabrication behavior. There's two primary forms of malicious synthetic fraud that are the ones financial institutions will tend to run into the most. The one is what we call, to Michael's point earlier, a lot of the stuff overlaps. The primary form of synthetic fraud that we see is something called first-party synthetic fraud, which is where consumers submit valid names, valid date of birth, but fictitious social security numbers. And the idea behind this is that you would seed these fictitious versions of yourself within the credit bureau system, and then use that to pass KYC checks, to open accounts, to establish fictitious credit reports, to obtain loans, credit cards, even deposit accounts if you'd like. This is the most prevalent type of synthetic fraud. It comprises about 80% of the synthetic fraud that we see across lenders and other types of financial institutions. It is a very sometimes shocking when people sort of first discover how easy it is to go create a fictitious identity this way and seed it into the bureau system. It is often sort of passes KYC checks, passes credit checks, and will just sort of often just classified as credit losses that could have been stopped earlier. The other main type of synthetic fraud, which is probably what you picture when you hear that phrase or that type of fraud, is what we call third-party synthetic identity, or a totally fictitious identity, a total fabrication of a name, date of birth, and SSN. This is about 20% of the synthetic fraud that we come across. So, and I believe Michael, actually, yeah, I think that sort of covers it's kind of baseline definitions.
Yeah, I mean, actually, thanks, Vivek. I mean, it's such a broad topic, and I think it makes a lot of sense that we subcategorize synthetic fraud, synthetic ID fraud, and tackle each of them with their own specific strategies. And yeah, Michael, how are you seeing this at BHG, at your past organizations?
No, it's really unique, and I think it's one that it's an interesting, the environment as a whole, right? Synthetic, both first party and third party, they've existed going back to the early parts of the 20th century, but the proliferation of synthetics, the strength of synthetics have increased so drastically over the last couple of years. At a prior lender, we partnered with Centilink around 2019, just before COVID hit, and really you saw a boom in synthetic identities, both in first party and third party scenarios, really start to ramp up. A lot of that is environmentally impactful, right? Because it's coming from the change in the SSA issuing of SSNs, going away from coded numbering systems to entirely randomized. So it got easier to create these synthetic profiles as a result. Vivek mentioned earlier about the idea of credit washing. You have, and I think I mentioned this as well, of the idea of these less than scrupulous or less than reliable credit repair agencies that are telling people who may have bad credit or didn't have access to credit in their past, had poor payment history, had bankruptcies, et cetera. Oh, this will be really easy. We can help you out. We'll just give you this CPN. It's entirely legitimate. And it's not. It's illegal by default. It's either entirely randomized or it's stolen from some individual that may have been deceased for 50 years, right? And you get people who aren't fully aware of what they're doing, and they're only trying to improve their station or their lives or otherwise, and they get into that. And that's what we see a lot of times with first party synthetic as well, is everything else looks legitimate, but you might see, particularly in the data that Centrelink makes available to us, of past negative history, either bankruptcies or even fraud alerts on their credit profile previously, can be a gateway to help identifying synthetic profiles, because we see that initial process of disputes and traditional first party activity, but also then leaning into, all of a sudden they have an older SSN that's legitimate, that ties to their date of birth, issuing date, et cetera. And then we had this new randomized one that all of a sudden you see a lot of activity on, and you see a shift to that. Additionally, when we talk about the ease of access and why these things have become so much more prevalent, is I can go and buy primary trade lines for a few $100s off of a database and make my profile look stronger and stronger with just a couple of seconds, a couple of minutes of searching and buying these profiles that, again, legacy fraud detection systems are not equipped to deal with this. And it relied a lot of times, before we brought on Centrelink, it was entirely reliant on educating our loan operations analysts, finding it on one-off basis where, hey, you're looking through a credit profile and you see a high prevalence of authorized user trade lines, or discrepancies in their in-file date versus their oldest trade line, instances that just don't make sense in the depth of the information. But that's a lot of manual processes. That's a lot of points of failure to have. And when we brought on Centrelink, that really changed, and particularly for Centrelink and the financial institutions as a whole, the emergence of systems that really were targeted and were designed to identify these situations completely changed, ultimately, our ability to at least mitigate what was occurring at really at an existential threat level, is what I think about when I think about synthetic profiles in particular.
Yeah, I completely agree, Michael. Yeah, I think this one like super interesting anecdote that we heard from one of our customers was like with the PPP loans that I referred to before. They were like, during that period, there's this whole proliferation of fraudsters, not just synthetic consumer identities, but synthetic commercial identities, right? The businesses creating synthetic identities as well, applying for these loans and defrauding basically the government, right? Because the government was funding a lot of these loans. Now that is stopped, they're all shifting focus to financial institutions now, right? So they're seeing that same trends and behavior kind of hit with their books. And it's pretty interesting that like how we can mitigate it, and along with working with like world-class data services like Centrelink, I think combining that with, again, what Vivek mentioned, some of the biometric data, like, hey, was this device, or was this IP address, or this ISP, or the region creating unnaturally high number of accounts, right, across a broader financial institution base, not just one bank, but looking at a bunch of banks. So I think those strategies have been working really well for us. I know, Vivek, if you've noticed that and the PPP behavior on the Centrelink ecosystem.
Yeah, I think PPP, I know I feel weird saying this. I guess it was a couple of years ago, still feeling the ripple effects of that in our financial system. I think for anyone who had worked in fraud before, when that program was announced, a lot of people raising the alarm, raising alarms about it, posting about it on LinkedIn and social media about, how much fun, how much of those funds were going to get directed to sort of criminal organizations or fraudsters. I think we're still doing that accounting. I think at the time there was a lot of, hey, let's go beat up the government about this, because they're obviously a very easy, big government can be a very easy thing to just to criticize and target. I think where it's starting to shift quite a bit. So in terms and looking more at the originated some of these riskier loans. There's actually a congressional report about this that released within the last year. We got a link to it on Google search for it. We're actually lenders during PPP. And so I think I may have cut out for a second, but am I back? Okay. Yeah, so it was just bringing up just PPP loans and exceptionally risky lenders that were originating those. So we actually submitted a FOIA request to go get all of that data, because it's all SBA loan data. And I've actually incorporated that into our platform from a research and design perspective. There's a tremendous overlap, surprise, surprise, between consumers that have committed lots of first-party synthetic identity fraud and those who have received PPP loans from those 5 or so lenders called out by Congress. And so we should have a blog post about this that describes it. But that sort of the presence of having taken out one of those loans is tremendously predictive for other types of fraud now.
Yeah. I was just going to say that also, like I mentioned this before, we brought on Centrelink in 2019, and we got to see, because we kept a lot of those lenders that ended up on that report essentially turned off their fraud controls. We got to actually see how incredibly important tools like Centrelink were during that time, because if you wanted an environment that allowed you to create essentially an endless list of synthetic identities, that was PPP, right? Either in employee information or just businesses, as Ravi mentioned, of these entire fabricated, that are built on multiple layers of fabrications, employee levels, shell companies, etc. It is something that I think we're going to be continuing to address and study for probably 20 years at minimum, and feeling the effects of, because it's going to continue to ripple out. And it's the great point of Vivek made of, we can connect those individuals that got PPP loans, and we can see discrepancies around how they're presenting their information now versus then, helps us to identify those instances. And a lot of times we see an overlap with synthetic profiles and synthetic activity corresponding with those scenarios as well. So it's really unique from our side of things. Just because it created a new dynamic to account for and necessarily have to address.
Right. Fascinating. Cool. Yeah, now to the interesting part of how do we mitigate all of this? I think these were some of the things that that we discussed offline before the webinar started. We just jotted these down, and I'll let actually Michael continue his talk on this, on how he's been looking at BHG on trying to address all of these problems and going beyond identity as well, as an organization.
Yeah, I think, appreciate it, Ravi. What I really think is necessary, what's a required step to take to combat this, was we talk about the complexity, the overlapping, the uncertainty around typologies, the ways that it presents in different ways, is you have to build comprehensive, cohesive, multi-layered systems that provide a better understanding. You can't just use one tool to try to stop a portion of it, a sliver of fraud, because ultimately there are strengths and weaknesses to all systems, and those have to have application at different points in your life cycle, particularly from a lending side, it has to exist strategically throughout that. And that's where really our partnership with Effective has been incredibly important, and where we're planning in the long term of being able to use those different point solutions at different stages in order to have effective amounts of friction at those stages that allow us to identify those really risky or very obvious overt efforts to defraud our company, versus pushing it on to later, to where we want to have full comprehensive understanding at all points and see something mature and advance a little bit further so that we can weed out potential false positives. Right? It's incredibly important to support the company growth, and the main job of Stu, particularly for BHG, is to offer funds to individuals who need them, to offer true trusted professionals with that. If we were simply just taking a one size fits all approach and we were using one system at the final stages, we would be deterring good customers and we would be missing out on the bad ones. So it's incredibly important to have. A lot of times you have sales departments that so heavily are baked into CRM tools that you would never try to create something without a sales force. But a lot of times fraud departments are missing out on that aspect that allows us to navigate, to control our tooling, to consolidate case reports, to track different behaviors across different systems, and connect those various solutions so that the team actually can figure out what is going on, because it's always a puzzle, and the complexity of that makes it that much harder, right? So that's a huge part with our partnership, both with Effective as that controlling arm, that central hub for all of our systems, such as Centrelink and such as other ones that we have partnered with over the years, to allow that to work together and condense and consolidate those into a perceivable and understandable picture.
Yeah, thanks, Michael. I think we learned a lot from your team on how to do this in a really, really comprehensive way. And yeah, I mean, the second point I think speaks to that, and no better partner there than Centrelink. And we've seen the power of using multiple of Centrelink services within the Effective kind of strategies, and utilizing, like Michael said, the right service at the right time, and building this 360-degree view of that end user and trying to identify fraud at the right time. Vivek, actually on that topic, like obviously you guys are pioneers on building world-class data systems, so would love to get your thoughts on that.
Yeah, so believe it or not, I'm going to say that when thinking about this and thinking about risk teams that I've seen that have struggled with this, risk teams that are good at this, the good ones aren't necessarily the ones that are going out and, shocking to hear me say this, that are going out and buying tons of Centrelink products and buying, have huge budgets on fraud vendors and tools and data. It actually has to do with their entire orientation to fraud in their organization. There's a huge difference between, and there's a couple of different sort of ways that I think about it. One, there's a huge difference between organizations that have cultures of data versus those that do not. So those that actually really understand from a data perspective what their inbound population looks like, what a typical consumer looks like, what it looks like on a day-to-day basis, what their operations queues look like on a day-to-day basis, and sort of transaction monitoring queues from a day-to-day basis. Huge difference between companies that are looking at those metrics and use them every single day versus those that do not. Those that do not end up having to be way more reactive and end up creating fraud rings or taking on very outsized loss events. The other is organizations that think about risk as really part of the product, as opposed to thinking about the risk teams that tend to struggle with this a little bit more are ones that may be thinking about their teams or their orientation just from like a loss prevention perspective, or just some sort of operational KPI or metrics. The ones that are really good at this, either they are quite embedded in the product, or they have very good, or there's sort of a great relationship between product management and risk that is thinking about this holistically.
Yeah, no, actually a great point. That speaks a lot to one of the third point that we discussed previously as well, is on the real-timeness of fraud, right? So previously, I mean, obviously for transactions, it was always there that, hey, if you're able to detect fraud in real time, great user experience and so on. But now real-time decisioning is as important at account opening time as well, right? So all consumers, even commercial entities, are now expecting to onboard in real time. So they're no longer willing to wait for weeks and months before a loan gets approved or their account gets opened. So the real-timeness becomes very, very important. And when we have partners like CentiLink that's refreshing their data sets and their models very, very frequently to identify the changing trends in the industry, that just makes it so much more powerful. And like Vivek mentioned, when you look at fraud as not like an independent function, but part of the product, you tend to look at this as a completely different problem, right? So how are you going to improve the user experience in the end by using your fraud mitigation strategies? And I think the last one, obviously, it's something that all three of our organizations do, and I'm sure a lot of our audience also do, is on like leveraging machine learning and AI, right? So the scale at which that we operate and the data that we see, we cannot rely purely on handwritten rules, right? And having very sophisticated machine learning models that, again, are being trained, are very agile, adapting to changing trends, become very important. But that's possible when there are true experts in the loop, and kind of fine-tuning and directing the AI and machine learning and the rules and strategies in the direction that they need to move towards. And Michael, I'd love to hear your thoughts on that space as well. Obviously, BHG has a strong credit underwriting team using a lot of machine learning. On the fraud side as well, you're doing some very interesting things there.
Yeah, I think it's a great point, and it coincides with what Vivek said about the collaboration that is required, right, between different departments, making sure that the fraud and risk teams are not this island and that are disconnected from it. But also it's the idea of systems and tooling, in our view, is meant to be supportive and supplemental to investigative teams as well. It gives that extra benefit to make this an efficient process to ensure that good customers get through. You have to have that balance, right? You have to still utilize trusted, experienced professional subject matter experts in terms of applying that, and in terms of continuing to train and improve the modeling and ensure that you don't end up in feedback loops, or because the biggest thing is fraudsters are great at identifying where weaknesses are in a system and trying to build their patterns in order to bypass those controls as well. So it's incredibly important to have that connection between the human side of things as well as the really dynamic and cutting edge technology. If you are turning on your systems in a completely automated fashion, you are more likely to miss out on certain aspects, or you getting back into this echo chamber of data that ultimately may be manipulated in such a way to render those systems as ineffective and as causing more strain on your system or on your total funnel than you ideally would want to see. So it's really, it's a constant balancing act between that. And that's what we always look for, is we want to create a combination of those different attempts and different structures in our teams.
Awesome. Cool. That brings an end to the topics that we wanted to speak about. Obviously, now is another interesting section, which is Q&A. We've received a few, but folks, if you're in the audience and you'd like to ask your questions, please post them. We'll try to answer as many as possible. I think we have 5 minutes left, so we'll try to go through them as quickly as possible, but please do post. I'll jump into the first one that we've received. Oh, this is again back to you, Michael. I think very relevant. Do you manually review any applications? If so, how? And what's the ratio between automated and manual reviews? Is there any ideal split that you suggest? How are your team structured and so on?
So yes, we do manually review cases, and our team currently reviews at a very high amount. But ultimately, what systems like Centrelink allow us to do, and effective, is to establish for a specific product, for a specific channel, allows us to set thresholds that, from a strategy perspective, we can apply hard cuts within the system. We can also apply elevated risk concerns around those. So you implement either a green, yellow, red system where below a certain threshold, you're comfortable proceeding with the apparent risk within that. The ranges of the scoring and the dynamism of those systems allow us to be not just taking a hammer to everything, right? And allowing good customers to go through without any impact from our team and keep us dynamic, right? Keep us small so we can focus on the most elevated or those really gray area accounts, and also take care of the really easy ones much quicker and much more efficiently. Right. So yes, we still do, and that's why we use. It's where those legacy systems will come in as well. It's incredibly important to have those in support of preventative tools and identification tools that also work in the whole system.
Yeah, just to add
Michael,
to the. Yeah, I was just going to add slightly to this. I think that where I've seen really good risk teams operate, and the way that they'll typically operate is they'll have the set of these sort of operational cues, like Michael described, that are focused on specific business KPIs or operational needs related to fraud. The really good ones will also carve out a little bit of space for sort of R&D cues. So things for maybe updating internal models, or to the point around AI and ML. If I were in a risk team, I'd probably want to have one person or some small set of resources dedicated to looking at maybe cues coming from unsupervised learning sorts of systems, and sort of making sure you're carving out a little bit of space for that is like really important, and where I think some of the best risk teams, what they'll do.
You have to be aware of the customers that you're dealing with, and evaluate how the models are performing against those specific pockets of population.
Right. Yeah. I mean, and BHG is one of our most sophisticated users of the case management system on our platform. So, and yeah, completely agree. I think just having experts look at cases manually is so much more powerful, because models take time to identify patterns, right? And having experts look at some gray area cases to take quick decisions, which in turn feed the models to eventually automate the decisioning. And two, having that golden data set, or even just evaluating, doing quality assurance on what's happening in the automated side, right? So having folks look at automated decisions and seeing how they're performing, the false positive ratio, those have a big value as well. And I think third area where we see our customers using our case management quite a bit is on the compliance side, right? So some compliances and regulations are a little bit tricky to automate. Some actually need humans to take those manual actions, especially if it is somewhere related to credit or even money laundering, like filing SAR reports and things of that sort. Humans are obviously experts, and people are really needed. Cool. Very related to that, actually, topic of the hour, and thanks to whoever posted this question, is the impact of AI on identity fraud. Obviously, I don't know if all of you have seen this video by the Center of Human Society. They spoke a lot about voice can be synthesized. faces can be synthesized. Video can be synthesized now with generative AI. So getting through document-based verifications are, I think, going to be a moot point. So how are you going to deal with this? Vivek, I'll let you take this.
Yeah,
and over
I
to
know
you.
we're about at time, so I'll keep it pretty brief.
Okay.
Yeah, I'm more excited about it from a fraud prevention perspective than I am concerned about it from a new ways to take on losses or new ways to defraud institutions. I think FIs need to be looking at it as proactively. How can they use this? Michael.
I would fully agree. We know that fraudsters are going to be looking at new technologies to try to get by and try to hide what they're doing. So financial institutions need to be open to making use of those, again, advanced technologies and the progression of tooling and systems and models in order to combat it. We have to be operating at that same level, obviously, with taking all things into account.
Fight AI with AI.
Exactly.
Cool. Yeah, thanks a lot, everyone. Over to you, Stan. But we would like to really thank all the audiences who attended. It was a wonderful conversation. Michael and Vivek couldn't have asked any better panelists than both of you. Thanks a lot for spending time. Super educational. Over to you, Stan.
Great. Yeah. Thanks, everyone. It's totally informational, innovative, dynamic discussion. Thanks, Michael, Vivek, Ravi. Please, everyone, take a few seconds to answer the poll here. I'll leave it up for a few more seconds. In the meantime, thanks again to everyone for attending today's session and for asking some great questions at the end. Again, thanks, everyone. Appreciate your time.
Thank you.
Thanks, everyone.
Bye, Michael. Bye, Vivek. Bye.
Cheers.